Welcome to Market Overtime. I'm Diane King Hall. It may feel like a long time ago, but markets rallied to new all-time highs in February. Since then, we've seen major sell-offs, rallies, and overall volatility that has investors on edge. Over the next hour, we will discuss what you need to know about tariffs, trade policy, interest rates, and more with the team from Charles Schwab. Let's kick off the show with Omar Aguilar, the CEO and CIO of Schwab Asset Management. Omar, thank you so much for taking the time to be with us and describe the state of things right now. So I want to hear your views on how investors are reacting to market volatility.
Yes, thank you for having me. Well, this is one of these periods of time where the emotions are as high as the level of uncertainty we have seen and experienced in the markets. The majority of our investors, are anxious. We have received at Schwab a record number of calls from clients, reaching out to their advisors to try to understand the different environments we're living. Clearly, the plans that they had at the beginning of the year are now completely different, at least in their way that they feel. And I want to emphasize this because in the questions about, how are clients reacting, this is a perfect and almost like a textbook's example of behavioral economics. The majority of time where you actually have things that you didn't expect, there is a reaction that tends to be emotional in nature. And, we do a lot of research about behavioral finance because even in periods of or short or long-term volatility, we experience these things because we are all humans. And the natural reaction is loss aversion. When you see a market, turning negative, immediately that sort of need for your assurances, your loss aversion kicks in very quickly. That's a very emotional, natural thing that clients are experiencing. We see paralysis. People get shocked. Immediately, you don't know, there's something that uncertain that you have not experienced before, or even if you had experienced before, you still don't know what to do. That's a very typical, a reaction that you see in these periods of high uncertainty. We also see people look at recency bias, and recency bias is an interesting one because what it does, it actually pays more weight or puts more weight on information that is recent than what it is, the long term. So if you think about it, even with the latest set of market downturn, when you put in perspective what has happened over the last 5 years, this is just a small portion of what you have experienced over the last 5 years. But at this point, as humans, we tend to put more emphasis on the news of the day or the news of the week or the news of the month. And therefore, people obviously react to that piece. And the last, that typical reaction that we have seen with clients is what is called home bias. And home bias means you basically want to go to areas that you know the most. So you actually, in periods of high uncertainty, you tend to go to areas that tend to be more home related or things that you're more comfortable with. And this is typical, when people go for the brands they like, where the food they like, or areas where they feel comfortable in there. And therefore, that's a very typical things that people have. Of course, when you put all these pieces together, there are questions that they have about, should I move my money out of the market? Should I buy more US? Should I buy? There's a lot of questions where people try to react to markets when they have levels of uncertainty.
So I'm glad you brought up behavioral finance, and I was curious to know, how are these emotions like fear, like FOMO, even what you mentioned about recency bias, shaping investors' decisions, and how do you avoid that?
Yes, and that is precisely a lot of the work that we do at Schwab to help investors. So when we receive this amount of calls, our work is usually to start by saying, well, the volatility already happened. In other words, there's nothing you can do to change what has already happened. And I think in many cases, we go back to the principles of basically saying well, let's try to come back to the plan. And I think when I say go back to the plan is something that we encourage clients to do, is to have a plan, a financial and an investment plan with an advisor, so that in periods of volatility, they know how to navigate. And that includes their behavioral biases. There may be people that are more cognitive in nature. That means that they try to make decisions with the frontal part of their brain. And there are people that are more emotional in nature that will try to react faster to different types of changes in the market. So the principles of what you have is, number one, is stay invested. There is nothing more important in the market than stay invested in the market. We tend to have a lot of information over the years that we clearly say time in the market is more important than timing the market. What that means is that if you stay invested for the long run, even if you see periods of volatility like the Brexit, like the euro, like the wars, like COVID, if you stay invested in the market, that tends to pay dividends over the long run. Yes, there will be periods where there will be high volatility and you feel unsettled, but stay invested is a big part of the plan. That allows you to reach your long-term investment objectives. Number two, stay disciplined. This is the perfect example of staying disciplined. And what that means is this is not the time where you actually need to make changes to your investment strategy. This is the part where you want to rebalance in a disciplined way. So if you ended up having areas where you have not invested over the years, this is a good time for you to try to rebalance your portfolio and try to create that more risk, profile that serves to your long-term investment objectives. And lastly, stay diversified. Staying diversified is a big component of investing that is so critical in this period of time, and especially within international, because as I said in home bias, when you look at international exposure of U.S. investors, most U.S. investors are underexposed to the international markets. This is a perfect time to create those. Stay invested, stay disciplined, stay diversified.
Yes, you make a great point about being underexposed, but even international investors were more U.S. focused in recent years and gaining more returns off of that focus. I know we've seen some outperformance abroad this year compared to the U.S. You mentioned rebalancing. Is there a need for reallocating or just to do nothing?
Yes, well, that is the usual way to look at this. We advocate for a very systematic approach to rebalancing, because there's a lot of areas where you normally try to look at it, and what that means is there is periods of time where even when the short-term periods of volatility move away from your long-term investment objective, that you probably can let things ride. In fact, the buy and hold strategy tends to be one that tends to drive performance in the long run. However, if you actually think about it, over the long run, equity returns tend to outperform, fixed income. And what that means is that, if you have a risk profile, you start with a 60-40 portfolio, 60% equities, 40% fixed income, there will be a period of time where that 60% exposure will get much higher. So this is a good time for you to just set up those, areas where you say, my exposure of certain asset classes or certain stocks, move, to a certain level, I'm going to bring it back. And what that is important is that it will allow you to reduce exposure to areas that are hot. That is the FOMO that you mentioned earlier. And they will actually put exposure in areas that are not doing so well. But that rebalancing strategy allows you to, on average, maintain the exposures that you want over time, which is a very important piece, especially because it's very hard to sell your winners. People don't do that regularly. They don't like to sell. They wait. And at the same time, nobody wants to swim, against the current. So nobody wants to buy those areas that are underperforming. So we tend to look at those things to say, well, this is a good opportunity to have that rebalancing strategy that is systematic, that allows you to set up those rules, especially in periods of high levels of volatility.
No, you make a great point about no one wants to sell their winners. Like, who does that? And then when you see some pushback on the winners, you start to have questions. Like, I think, for instance, of the Mag 7 trade, which had performed so well, but has faced very, very difficult battle this year. Now, there's another broader-based question that has been floating around when it comes to markets, in particular equity markets. The question is, buy the dip or sell the rip right now? How do you view that?
Well, this goes back to the whole idea of trying to find that dip. And, I would probably say, the probability that somebody can find that button is actually, very low. We have done analysis over longest periods of time since we have data of equity markets, and it is very unlikely that you will be able to find that dip. In fact, big part of, the discussion about timing the market is precisely, missing a few days in the market when the market is actually up, it creates a significant difference. But finding those, which is very little probability, it is very difficult to do. So our approach tends to say, well, because you can keep your mind away from trying to find a bottom, the best thing to do is to go back to what we discussed, which is, okay, if we're going to look at our long-term investment objectives, focus on what you can control. And what you can control is looking at your risk profile and making sure that you are comfortable with the level of risk that you're taking. And therefore, if you think that in this case you're overexposed to equity, well, this is an opportunity to maybe reallocate so that you actually stay in a risk profile that you like. Or vice versa. If you think that you have been underexposed to equity, this is a good opportunity for you to put exposure into equity, but just with the objective of failing your long-term investment objectives, not just because you want to find that particular dip.
And then let me ask you this. What learnings, or are there any learnings from that recent unexpected downturn in the market that we experienced, right? Many had characterized it as a self-inflicted shock. We saw so much volatility that it reminded you of the Great Recession, the GFC down here at the stock exchange. What are some of the takeaways from this moment in time that you see already?
Yes. Great question, and certainly there's a lot of learnings from what we're experiencing, so far. Number one, as I said at the beginning, nobody expected this. I think all of us have a different plan. If you ask us in January and what we actually experienced just in the last 3 or 4 weeks. And I think what that means is, for the first takeaway is, you have to expect the unexpected. There are certain things that you don't necessarily control and you don't necessarily know they will happen, but they do happen. You mentioned the GFC and you mentioned COVID. There were other great examples of things that were, happened and nobody expected them. They all of a sudden were there rounding, but by the time, the market realized or things were happening, you were not ready for this. So that's the reason you need to have that discipline plan that we discussed before. The other piece we discussed, many times with our viewers and with our clients, this idea that you are overexposed to certain areas, the Max 7 being the perfect example, and how we always try to say, well, it's a good idea to diversify, to try to reduce that concentration on cap weighted and try to reduce exposure to momentum, even if it feels a little painful that you're basically doing everything against what the market is doing. So trying to stay that discipline of, even if you have to sell when the market is going up or you have to buy when the market is going down, that idea of rebalancing and staying strategy-wise consistent is actually, very important. And the other piece about diversification is, well, guess what? People thought that international was going to underperform the U.S. forever. And I think we observed so far this year that that was not the case. And therefore, maintaining that level of diversification is always good. Diversification actually works.
When it comes to economic data, we've still continued to see some strength there. We saw recently strength in durable goods orders, the job market still holding up. There is obviously concern that we will see impact down the line this year with regard to economic data from the tariffs. What indicators are you watching most closely to assess cues for the direction of the market?
Yes. So the good news is that a lot of what I'm talking about in terms of long-term investments usually tend to rely on, information that is, hard data. And that is economics, that is macroeconomic, to give us a sense of, the health of the U.S. economy and the global economy in general. Also, fundamentals of the companies. Company fundamentals and earnings that obviously rely on what it is, as well as intrinsic value of what bonds, are telling us. And what we're observing right now is equity market volatility is a good reflection of the soft and sentiment data, whereas the bond market is giving us probably a better picture of how the macroeconomic conditions are. So a lot of the changes in yields basically give us a sense of what the potential impact, might be. So when we look at this, we look at how the bond market is behaving with the expectation of knowing what was going to be the monetary policy, what is going to be inflation, what are the inflation expectations, and what is sort of the term premium is telling us in terms of the implied of the bond yields. And that what it tells us is like, well, in many cases, we still expect rates to come down. The Federal Reserve is still struggling between inflations and, economic stimulus, or at least, trying to just get that piece. But at the same time, understanding what the expectations through the bond market of Fed actions. That's one big piece. The other piece will be earnings estimates. We still believe that, in the current context, the earnings estimates out there do not take fully into consideration what the impact might be of tariffs, because the reality is we still don't know. These tariffs have not yet been implemented, and therefore it's very hard to really assess what the future earnings impact might be. We also know that no matter what, they're still going to have to come down. So, we're looking at earnings and equity more to get a sense of where the sentiment might be, but we're also looking at bond market information to look at what the macroeconomic and the health of the U.S. economy might go.
Okay. And then Omar, as someone who has experience with both strategy and operations at Schwab, how do you balance long-term planning with short-term market shocks?
Yes, well, that is a great question. Our teams and everybody that works in here usually has the idea of maintaining and preserving as much as we can in terms of shareholder value. The whole objective of here is to continue to provide investors with access to markets so that they can focus on other things. And what that means is we're trying to stay in the long-term perspective to try to reduce costs, trying to maintain exposure, and try to basically take very measured risk in areas where you have. So we do have to balance between risk and returns, investment objectives of the different strategies that we manage. But at the same time, in periods of short-term volatility, we apply the same concepts that we have. We try to take the risk low, like at this particular moment, we basically have, probably the lowest level of risk that we can take in most strategies. Mostly because it's very unclear, where the market or where the economy is going to take us. And therefore, the only thing that we can control is the amount of risk that we put in our strategy. So that's a big part, what we have. Our traders and our portfolio managers are also humans who also have, behavioral biases. So we have to work with them to keep these concepts of being foundational of diversification, driving the cost low, try to take opportunities for, tax strategies that are efficient that may work in favor for some of our clients, as well as just maintaining that discipline to try to maximize the probability of getting their investment objectives achieved in the long run.
All right, great insight, great perspective, Omar. That's Omar Aguilar, CEO and CIO of Schwab Asset Management. Our thanks to you, Omar. Coming up, Jeffrey Kleintop stops by to give us the global perspective on markets, taking us through which countries are most impacted by U.S. tariffs and how investors are playing international markets. Welcome back to Market Overtime. I'm Diane King Hall. For insight into global markets, I'm joined by Jeffrey Kleintop, the Chief Global Investment Strategist at Charles Schwab. Jeffrey, it's so great to be with you today. So let's start out with this. How would you describe or characterize the global impact of U.S. tariffs as it stands?
Well, Diane, last week we added to the updated forecast we've been getting from global economic organizations like the IMF, the OECD, the World Bank, and the World Trade Organization. All of them have lowered their growth outlook for nearly all countries and regions since the last forecast update, which was around the start of the year. The overall impact for the global economy shaves about 0.5% off of 2025 GDP. The biggest hits were to North American economies, but the IMF did not forecast a global recession. In fact, the only country they forecast to have a negative GDP was Mexico, negative 0.3%. That's basically flat. Given that country's dependence on exports to the U.S., it's hit pretty hard. But not only is there much we don't know about how tariffs evolve from here, it's also important to take all these theoretical estimates of the impact of tariffs on the global economy with a big dose of reality. What I mean is we don't know how successfully the tariffs will be avoided, but we do know there'll be efforts to do so. The incentives to avoid tariffs are super high. China tariffs are over 100%. but only 10% or less on neighboring countries where Chinese businesses have some subsidiaries. And one way they can do that is by transshipping from China to Vietnam or other countries on the way to the US. That's one way they can avoid paying those really high Chinese tariffs. And the data shows that Chinese companies have been increasingly doing this. Another way is to under-invoice the value of Chinese goods. The value of imports claimed in the US has gone from being above what was claimed to be exported from China, which was over-invoicing to get money out of China and avoid capital controls prior to those tariffs back in 2018 and 2019, the Trump 1.0 tariffs, to now being more than 100 billion below, reflecting under-invoicing in the US to avoid tariffs. Now, in percentage terms, Diane, this means that already 20% of the value of China's exports to the US are not being accounted for in the US imports data. And if we combine that with what I calculate for transshipping to the US, it's possible that nearly 50% of Chinese company exports to the US are already avoiding the bulk of the tariffs. So there are real world considerations to these theoretical forecasts that matter to us as investors in trying to assess what the hit to growth may actually be.
Let's talk a little bit about that avoidance strategy that you just talked about. When I think about it, it reminds me of when you're sometimes trying to take a shortcut home and it ends up being longer and it just, it's just not as great as you expected. When you extrapolate that to, the avoidance that you speak of with regard to China's goods, especially, and China's economy, would it still suffer?
Yeah, you're right. I mean, the tariffs are likely to have a negative impact on China, but China is looking to boost domestic growth as an offset to weaker trade with the US. About half of China's GDP comes from consumer spending inside China. Only about 3% comes from direct exports to the US, with maybe another 3% coming from the indirect exports to the US that I just talked about that pass through other countries or aren't otherwise accounted for directly. So clearly, 50% versus 6%, domestic spending is a lot more important to growth. And if they can boost it meaningfully, it can more than offset falling exports on overall GDP. China's growth last year was around 5%. Most of that was exports, not consumer spending, which has been very soft, kind of at recession levels. So if consumption can rebound this year, it can offset a slide in exports, and that's the plan. China has three budgets: the government funds budget, the state capital operations budget, and the social insurance budget. If we combine them all, it results in a plan to spend 11% of GDP this year. That's a record. So far, spending in Q1 was not much greater than last year, so we're not seeing full-scale stimulus being enacted just yet, but they were likely waiting to see what the April 2nd tariffs look like. So it's the incoming data we're going to be watching, and China's stock market is up about 10% this year per the MSCI China Index measured in dollars. That's widely outperforming the US S&P 500, and that's helping lift emerging market stocks post gains this year so far, despite China being in the tariff crosshairs. China also, by the way, outperformed in 2017, the first year of Trump's first term, and the market's been more volatile this time, but been on a rising trend.
Let me ask you this earnings season, one of the patterns I'm noticing on earnings calls, the analyst calls, is the word uncertainty because of the macro picture. And, you even have some companies pulling guidance for this year. What are you noticing about the impacts of tariffs on business operations this earnings season around the world?
Yeah, a lot of business leaders are being conservative in taking down their numbers. I wouldn't say they're being overly pessimistic here. They just don't know. There's so much that's unknown. We've seen shipping numbers this past week. Last week, the number of containers coming into West Coast ports from China was double what it usually is. It was up 50%, but it's about to drop off. Over the next few weeks, it's really coming down because those last shipments that were ordered ahead of those tariffs have now arrived, inventories have been stocked up, and now we're really starting to see a pullback that could eventually lead to some shortages, all kinds of issues if these tariff issues aren't resolved. Global economic think tanks I mentioned, the IMF, OECD, World Bank, they only see a moderate hit to GDP growth, but earnings might be a different story. Earnings are much more exposed to trade. Big businesses generally that populate the indexes are multinational. They have a lot of international sales, and U.S. import tariffs have been mentioned on nearly every earnings call I've listened to. The number of companies in the S&P 500 with downward revisions is similar to what we saw in the 2008 global financial crisis and the 2020 pandemic. So it's like a crisis level of business leaders bringing down their estimates. But the number of downward earnings revisions for non-U.S. companies, they're up. but they're far below past crisis peaks. And that may be because non-US earnings are just less exposed. Even in Mexico, I mentioned Mexico's GDP is expected to be negative this year due to the tariff impact, but despite that forecast, Mexico's stock market, one of the best performers this year, not seeing widespread earnings downgrades either. In fact, the stock market's up 22% in dollar terms in Mexico this year. That's because most of the companies are just not exposed to tariffs. It's like Mexico's Walmart and its Coca-Cola distributor and its telecommunications company. They don't really have any trade or tariff issues. So those earnings are insulated from tariffs in a way that economic growth is not. And that's, again, an important distinction for investors. And it's why the earnings outlook remains brighter overseas.
So let me ask you, that begs the question about the outperformance that we've been seeing globally compared to the U.S. You mentioned Mexico, but of course, we've seen some gains in Europe as well. When you think about this global performance, especially compared to U.S. stocks this year, do you expect those patterns to continue, or do you expect it to kind of return to what we've seen previously, that story of U.S. exceptionalism?
Diane, no, I think it's going to continue. I think international stocks will continue to outperform. You know, our outlook for 2025, published late last year, we forecast international markets would outperform this year, and they have not let us down anywhere you look. And we continue to favor international diversification with an emphasis on Europe. European stocks, as you mentioned, have recovered all of their April 2nd Liberation Day losses. You can see in the chart that we put together, that's not true for the U.S.'s S&P 500, and that isn't simply because of the poor performance of the U.S.'s Magnificent Seven. It's because you can even see it in the equal weighted indexes, which show what the average stock is doing. They're showing a similar gap. So that illustrates it's not just a handful of mega cap stocks that account for the difference in performance. The average stock in Europe is outperforming the average U.S. stock. And it's worth pointing out that this isn't new. I think this is part of a longer term trend. International stocks have outperformed since this current bull market began 2.5 years ago in October of 2022. Sure, they've widened out this year, but they've been performing well for a while. And international diversification is really paying off for investors. I often get asked, how much international should someone have in their portfolio? And my answer is always the same. Probably more than you have now, since so many people have let their portfolios become more and more U.S. and tech concentrated over the past decade when international wasn't performing well. But it's not too late, Diane, to rebalance back into international stocks, even after this run of outperformance.
Okay, I'm glad you mentioned that perspective, and I'm glad you even brought up the mega cap perspective, the tech sector. What sectors, though, look best positioned to weather the volatility that we've been experiencing of late?
You know, generally speaking, more defensive stocks tend to do better in periods of high volatility. But what you get along with that is then maybe not catching up on the upside. What I found is that across sectors, companies that have more domestic exposure, less border exposure, less tariff risks, are consistently doing better both on up and down days. For example, if you look within the European universe of stocks, yes, they're outperforming, but those that are more domestically focused, which includes companies like energy and utilities and financials, which are more domestically focused, they are tending to outperform relative to more export-focused businesses like apparel or footwear or even technology. So focusing more on domestic exposure seems to be a winning bet this time.
All right, Jeffrey, always great conversation with you. That's Jeffrey Kleintop, the Chief Global Investment Strategist at Charles Schwab. We appreciate you. Up next, we'll look at the risks of a recession, investor sentiment, and what to expect from the central bank and Fed Chair Jerome Powell. Welcome back to Market Overtime. I'm Diane King Hall. Shifting gears now to discuss the risks facing the economy and more. I'm joined by Ann Sonders, the Chief Investment Strategist at Charles Schwab, and Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research. It's great to see both of you. Ann, I want to start with you. You put out a report in mid-March about rising recession risk, but of course that was before we had that escalation in the trade war, though there's been some cooling in some of the rhetoric. How are you thinking about that risk factor now?
Well, Diane, shortly after the Liberation Day announcement, particularly in light of what we saw happen to the market in that very brutal 2-day period, just about anybody that publishes recession odds upped those odds. What's interesting is to the extent you can call what's happened in the last week or so a de-escalation, I think there's still a lot of uncertainty around that. I don't know that that eases recession odds all that much. It may mean that, assuming we get a recession, that it's not as severe as it might have been if we had allowed that escalation to get even worse. So I think there's better than even odds of a recession in this environment. And I think maybe best case way to think about it at this point, even if there's further de-escalation, if you're a business and you've compressed your capital spending plans, your long-term investment plans, maybe it doesn't go further down from there, but it may end up looking like an L, if you can think of that visually. So I think we're not out of the woods yet in terms of the economy, for sure.
It certainly seems that way, especially when you think about what we hear on some of the earnings calls recently with some companies just pulling guidance. So let me talk to you a little bit about, Liz, and I want to hear your thought about the link between the volatility that we've seen in the equity market and the economy. How would you frame that? Is there a direct link?
Well, I think one of the direct fundamental links between what goes on in the economy and the market is through the earnings channel. And maybe particularly important to talk about it in this environment, given that we're right in the teeth of earnings reporting season. Now, admittedly, the earnings being reported are for the first quarter. So that predated the serious escalation in the trade war via the Liberation Day announcements and what's happened since then. I think what's more interesting is what companies are saying about the future, or what they're not saying about the future. So you've got a rising number of companies that are just withdrawing guidance altogether. And this is already a backdrop of 18 consecutive weeks now of downward revisions to 2025 S&P earnings. And I think when now analysts will be a little more left to their own devices in the absence of that precision around guidance, I think they are going to err on the side of bringing estimates down. So post-election, as we headed into the end of last year, estimates were for about 15% earnings growth for this year. That's now down to 8%, and I think the direction of travel is still lower from here. Then the other connection is that we have the largest share of household assets in equities ever in history. It's in the mid to high 40% range. It obviously fluctuates with market performance. So there are feeders in terms of the wealth effect from what happens in the equity market to the economy, more so than if you have a lower exposure by households to equities. So those are the two channels that I think are most relevant right now.
All right, Kathy, I want to get your thoughts on the Federal Reserve's path from here. There's been a lot of focus on Fed Chair Jerome Powell, especially given some comments from the president, and as it relates to the direction of interest rates. What are you expecting the Fed to do this year, especially given all the recent cross currents from trade policy?
Well, I think Powell in his most recent comments was pretty clear that they don't plan to do anything right now, that they are in timeout or on hold. And the reason is for the same reasons that Lizanne is citing about what businesses are doing or not doing. The Fed can't really assess where we are until they know about policy. A little bit more clarity on policy, I think, is the way that Powell said it. So we have the tariffs proposed, but they keep changing and pausing and on, off, et cetera. And what Powell said was that they had done a base case analysis at the Fed based on the previous set of tariffs in the previous Trump administration, but that these tariffs are much larger and much more broad-based than they had anticipated. So they're back to the drawing board on that analysis. And until they've done that analysis, they really don't feel comfortable making a move on monetary policy. So I think the idea is that Powell just wants to say, we're on hold and we're waiting for more information, just like everybody else trying to function in the economy. And so our expectation is we're still penciling in like 2 rate cuts this year, but towards the end of the year.
Okay, so you think that will be towards the end of the year. And I know we continue to hear the messaging that this is a data-dependent Fed. We've seen some pull forward of demand already in terms of some of the numbers. What are you expecting that could potentially spur the Fed to take action even sooner?
Oh, I think the primary driver would be a rise in the unemployment rate. You know, the Fed has a dual mandate for full employment and to keep inflation stable at low levels. if the unemployment rate were start to rise towards 5%, so if we start to see incremental increases over the next couple of months of 0.2 or 0.3% from the low 4% region, I think that would get the Fed off out of pause and into action. It's an important metric for the Fed. Employment is actually a lagging indicator, so that would indicate already that the economy is very soft. The other thing would be, just much more softness in the economic data than we've seen. It's softening, but it hasn't signaled yet that we're tipping into recession. And then finally, if some sort of financial condition tightening occurred, then the Fed might move. But it's primarily going to be that unemployment move that would get the Fed to take action.
Liz Ann, I want to hear your thoughts on the assessment of investor sentiment, especially because we've seen sentiment weaken, whether we're talking about the consumer or the C-suite. How would you characterize where investor sentiment is now?
It's kind of an interesting mixed bag with investor sentiment. I've tracked sentiment indicators for decades. And one way to think about measuring investor sentiment is the indicators, the indexes that are attitudinal in nature. So there's a lot of survey-based data on investor sentiment. You're asking their opinions. And then there's behavioral bucket of investor sentiment, what they're actually doing. And we're in a little bit of a mixed situation right now. In the last couple of weeks with this rampant volatility in the market, we've had these fits and starts where you see a big spike in bearishness, a big drop in bullishness. One of the most popular indexes that tracks that attitudinal sentiment is put out by AAII, so American Association of Individual Investors. They've been doing a weekly sentiment survey since the mid-1980s. And alongside this heightened bearishness and much lower bullishness, which all else equal can often serve as a contrarian indicator, you haven't really seen commensurate action in terms of what they're doing. Even AAII tracks the invested exposure of their members, and that's only a few percentage points off a high. You can also slice it, dice it. AAII tends to be older, more seasoned investors. If you look at professional investors, they're more cautious in this backdrop. But some of the newer retail traders are still in a buy the dip mentality. So a big divergence that's happened there in sentiment. I think we may need to get to a point where there's a little bit more of a washout. Still doesn't represent a perfect timing indicator, nothing is, but that tends to serve as a more definitive contrarian indicator when you have that washout both on the attitudinal side and the behavioral side.
Okay. Kathy, I want to get your thoughts on some of the patterns we've seen in the dollar recently. We've seen some weakness. We've seen some stabilization most recently, but it was concerning the momentum, the speed in which the dollar was weakening in particular, and then the volatility in the bond market had a lot of people concerned all the way, honestly, it seemed to be up to the White House. What do you make of it, and what does it suggest for markets going forward?
I think it's a reflection of the markets reassessing the outlook for the U.S. economy in light of tariffs. And I think that you saw the drop in the dollar was probably exaggerated by, some leverage trading, et cetera. But it was the steepest 1 month decline we've seen in a long time, in a decade or more. So it was a very sharp sell-off. And I think that reflects this change in sentiment when we got those big tariffs, and combined with the criticism of the Federal Reserve and the talk about terminating Powell from the chair position, that really got people to reassess where the U.S. is going in terms of economic performance and the underlying structure of our institutions. So we saw some of that selling. I think was mostly foreign selling from what we can tell. We get the data with a lag, but it looks like from what we can see in the weekly data from Japan that Japanese investors sold U.S. Treasuries for about 6 consecutive weeks. Now they've come back into the market, but that's the largest holder of U.S. Treasuries outside of the United States. So that's significant. It looks like it was households, not Bank of Japan, not the federal government agencies. And so I think this is a reassessment, and it's very unusual to see the dollar drop and bond prices drop or yields go up at the same time, that caught everybody's attention. And I think that that's just a reflection of the turmoil that we have off of various policies. Things seem like they're starting to stabilize now. I will say, if we pursue these aggressive trade positions and this policy going forward, the dollar is likely to continue to trend lower over the rest of the year. But that's very much policy dependent. But we don't also think that this is somehow a shift in the dollar's position as the world's reserve currency. I think this is not a reflection of the world moving away from US dollars permanently or for that reserve usage. It's more just a reaction to the shift in policy that we're seeing and the economic impact that it's likely to have.
I think that's a great response, especially because at this point, what else would replace it? Liz Ann, I want to get your thoughts on how investors should be thinking about navigating the uncertain equity market environment. Again, we've heard that term time and time again recently on earnings calls. So how should investors proceed?
Well, it is, needless to say, a very, very tough environment. And I would suggest trying to trade around these short-term gyrations. That's probably a pretty tough call. You'd have to maybe have an advanced Truth Social feed to get some of the incoming tariff-related announcements that as we've all learned, can cause really, really big swings, sometimes on an intraday basis. Taking the lens out a little bit further, the more defensive segments of the market have performed relatively better. You have factors like low volatility and stable dividend yield and stable profit margins. From a factor perspective, those have been some anchors to windward that at least helps cushion some of the downside. For the the bulls out there, or those that want some sort of bullish sign, let me just throw something out that's a little bit breadth oriented. So there's a breadth indicator called the Zweig breadth thrust. Now I mention it, it's near and dear to my heart because the creator of it, Marty Zweig, the late great Marty Zweig, was my first boss in this business for 13 years, starting in the mid 1980s. And it looks at the number of advancing issues on the New York Stock Exchange relative to all advancing and declining issues. And lots of detail to the definition, but basically when you cycle very quickly from a really low level and you pop to a much higher level, that triggers the thrust. Based on history, other than the 1930s, and maybe that's an important reference point given we're talking about tariffs here, 6 months later, the market was up every time. But the exception was the 1930s. But I just wanted to maybe give something more optimistic for people to at least hang a short-term hat on.
Okay, well, I like the optimistic take. Also, I think it's an interesting take to say we could potentially see Truth Social being a leading indicator. Kathy, speaking of an optimistic take, you've said that volatility often creates opportunity. Where do you see opportunities in fixed income?
Well, we think that current yields where they are on higher credit quality bonds look pretty attractive. So you can get, if we take the aggregate bond index as an example of investment grade bonds, in a larger sense, the yields are above 4.5%. Some in the investment grade space are up to 5%. And the duration is around 6 years. So you don't have to go really super long term and commit and get that interest rate volatility. So that looks good to us for base. And then if you're in a higher tax bracket and a high tax state, which many of us are, municipal bonds, it's usually an individual investor driven market. So oftentimes it lags a little bit and that creates opportunity. And right now the tax equivalent yields are really very attractive, 6%, 7%, in some cases even higher. So take a look, tax day was just recently. Take a look, and if you're one of those folks in a higher tax bracket, in a high tax state, take a look at the muni market because it really hasn't caught up with where the treasury market is.
And one of those folks who owed, not a fun time. All right, we'll leave our conversation there. Opportunities to look for on both sides of the equation. Today, joined by Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab, and Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research. Our thanks to both of you. Coming up, we'll get the view from Washington with insight on tariff negotiations, tax policy, and the early moves of President Trump's second term. That conversation just ahead. Welcome back to Market Overtime. I'm Diane King Hall. We're shifting our focus from Wall Street to Washington. For that, let's bring in Mike Townsend, Managing Director, Legislative and Regulatory Affairs, Charles Schwab. Mike, it is great to have you with us today. So let's start out with this kind of a comparison. Let's talk about the first 100 days of Trump's second administration compared with other administrations, including his own. How would you characterize that?
Well, Diane, obviously the sheer volume of stuff that has happened over the first 100 days is pretty incredible. But I think you need to start with executive orders. More than 130 executive orders have been signed across a whole range of issues. That's way more than any previous presidency. And then we have the tariffs, sweeping changes to tariff policy. So I think that's obviously been a big one, but you've got to look at the market, and the market downturn has been, worse than any of the last 6 presidents, including Trump's first presidency. So that's certainly been a negative. I think one thing that we haven't seen much of in the first 100 days is much out of Congress. Congress has been working on this big tax and spending bill, but they haven't really produced anything of note yet. So that's been sort of another negative, I think. But just so much to kind of wrap your arms around in this first 100 days. It's been pretty incredible.
Mike, I want to get to that bill in just a moment, but I want to get one more take on mood. And when you think about mood in Washington, especially because one of the things we've looked at a lot recently is sentiment and that soft data that was the first, kind of headwind, I guess, for the markets. But what is the current mood or sentiment like in Washington, especially when it comes to tariffs and trade policy?
Yeah, I think like the markets, like investors, I think people in Washington just want to know where things are headed on tariffs, because it has seemed to change so much. It's on, then it's off, then it's partially on. And I think that's just really hard. And I think members of Congress are starting to hear about it from companies back home. And, the companies just want clarity. Members of Congress want clarity on what's going to happen. I think the interesting thing about the tariffs right now is we're in this 90-day pause for the reciprocal tariffs. We obviously have the baseline 10% tariffs across the board are in effect. But, the administration has sort of touted this 90-day period as they're going to unveil a whole bunch of trade agreements. Well, we haven't seen that yet. We have seen talks ongoing with Italy, with India, with Japan, with other countries. But I think members of Congress want to see some real results that they can point to when they're talking about this back home. See, we're getting negotiations, we're getting trade deals done. And so I think there's going to be increasing pressure on the White House to bring some of those deals to fruition, have some agreements, even if they're not, in-depth deals, but just progress being shown, I think is what Washington really wants to see.
I think everybody really wants to see at least one deal on the table, because that could potentially give an early template for others. But let's talk about that bill that you mentioned. Lawmakers working on that sweeping bill that includes both tax cuts, spending reductions. What's the outlook when it comes to that for, say, individual taxes? And then timing. What's the timing for getting that bill across the finish line? Do we have any indication of that?
Yeah, Diane, I think the month of May is going to be absolutely critically important, because up to now, Congress has been really focused on sort of broad outlines of this bill, sort of big numbers, how much in tax cuts, how much in spending cuts. Now the dirty work has to be done of figuring out every specific provision. So every specific line item cut that's going to happen, every tax provision that's going to happen. And that's going to be really tricky, because that's when you start to get these trade-offs where members are like, I really have to keep this thing, so let's cut somewhere else. But then some other member of Congress is like, I really need to keep that thing, and we don't want to cut that. So I think you're going to see a lot of this kind of horse trading going on as they try to get these specifics done. In terms of the tax side of things, I do think the baseline is extending all of those expiring tax cuts that are set to expire at the end of the year. Those are the 2017 cuts that were part of the first Trump administration. So we're talking individual income tax rates, estate tax, higher standard deduction. I think those are likely to be extended. The real question is what happens to all of those other ideas that have been floating out there from the president. No tax on tip income, no tax on Social Security benefits, no tax on overtime hours. Those are the tough decisions that are going to have to be made. How many of these things can fit in this bill? In terms of timing, I think getting it done by August 1st would be a huge accomplishment. I know there's a lot of rhetoric about they're going to get it done much faster than that, but this is a big, unwieldy bill, and it's going to take a while.
Yeah, and it's so interesting to think about how we started the beginning of this year, and the theory was that that was going to be the piece of his platform that came first before tariffs, but it's been tariffs before tax policy this time around. So let me talk. I want to get your perspective about his congressional Republicans and how they're feeling with regard to patience with the president over trade policy, over proposed cuts by DOGE, the Department of Government Efficiency. Is there a risk that they're starting to lose patience, or, just kind of fretting about the pace of some of this?
Yeah, I think there is. We're just coming out of a 2-week break where all members of Congress were back home in their districts over the 2 weeks on either side of Easter. And I think they got an earful from constituents, from companies in their district. And it's not just about the tariffs, although I think the tariffs are really important to companies. I don't think the average shopper has seen the impact of the tariffs much on the shelves yet. They will down the road, but probably haven't as much yet. I do think those DOGE cuts is where there's potential for real pushback, because it's not just federal workers in Washington, D.C. It's not just closing down, USAID or other agencies. It's the ripple effects down into the local community where, the local hospital is losing its federal research grant, or the local university is losing its grant, or the nonprofit that relies on federal dollars to operate and provide some service in Congressman so-and-so's district. I think that's where the real pushback is going to start to come back and put pressure on these guys. I mean, remember, at the end of the day, these guys want to get reelected. And, if voters are upset with them back home, that's where the pressure point is going to come. I don't think we're going to see a big sweeping rejection of the president's proposals, but I think you're going to start to see little signs of pushback and concern that this isn't playing as well at home as they would like.
They want to be reelected, but with regard to the president, there's essentially no reelection on the line. And now it seems like maybe this term that he's less influenced by the stock market moves. His first term, it did seem like there was influence when shaping policy. Is that the case now, that he seems to, what we seem to see, that he's just less influence and it will move forward with hard-hitting policy, especially, for instance, when it comes to tariffs?
Yeah, look, I think this president has believed in tariffs for a long, long time. I mean, this is not a new position for him. And so I think he really believes in it. That said, I do think that he has an eye on the markets. We've always known that he's watched the markets really carefully. And certainly on that day when the broad reciprocal tariffs were going into effect, and they were in effect for a matter of hours before he paused them. And part of the reason he paused them is he said the bond market was starting to look a little queasy, which I thought was a great word. But, it was clear that he had his eye on the market that day, and he was worried about what was happening. And I think some of the people around him said, we need to step back, maybe take our foot off the gas on this a little bit because of the market reaction. And, we've seen a lot of volatility as a result of these policies. So I think it's probably true that he is less influenced by the market than we have seen, certainly in the first term, but it's clear that it's still a powerful factor in his thinking, and I think will continue to be going forward.
And then, Mike, let me ask you this question. I just want to get your final thought on either. What is Wall Street missing or the bond market missing when it comes to activity from Washington and the White House?
Well, I think the biggest thing that hasn't really been counted yet is the fact that those 10% baseline tariffs are in effect. There's been so much headlines about China. There's been so many headlines about the reciprocal tariffs being on and then off. But the baseline tariffs are in effect, and that already by itself gives us the highest tariff policy we've seen in a century of time. So I think that's something that the markets are still going to try to be figuring out. I think the average person is going to start to see effects on the shelves when they're shopping, and that's where the pushback may come. So I think that's what the market is going to be watching. What are the implications of these 10% tariffs, setting aside all the other tariff news that's going on? The baseline universal tariffs, I think, are going to be a big factor going forward.
All right, great perspective from Washington with our very own Mike Townsend, Managing Director in Legislative and Regulatory Affairs, Charles Schwab. Thank you, Mike. And thank you for joining me for this special edition of Market Overtime. I'm Diane King Hall. Remember to watch new episodes every week and to watch the full archive on the Schwab Network YouTube page.